What's up guys, welcome back to InvestingPH. Today we are going to evaluate a company that has been around for a long time. I am sure a huge percentage of Filipinos have already tried their products. This is Universal Robina Corporation. Let's see how it does in my checklist and if it's a good buy right now. So let's start. First of all, would really appreciate it if you click the like button, and I just noticed a lot of my viewers aren't subscribed yet. So please do subscribe, would really mean a lot for my channel. Also, I just want to remind you guys, this video is for educational purposes only. Please do not base your investing decisions on what I say. Still, do your own research about the company. All of this are just my own thoughts. Anyway, who is Universal Robina Corporation? URC is one of the largest branded consumer food and beverage product companies in the Philippines. The company has a significant and growing presence in the ASEAN and Oceania markets. It is among the Philippines' pioneers in the industry. It has been operating for over 50 years since Mr. John Gokongwei Jr. established Universal Corn Products Incorporated in 1954, a cornstarch manufacturing plant in Pasig City. URC is engaged in an array of food-related businesses, including the production and distribution of branded consumer snack foods and beverages, commodities such as sugar and flour, and agro-industrial businesses, mainly hogs, animal feed, and other related products. So just a quick timeline of their history and their milestone. This company really dates back a long time ago. You can see this timeline in their website, so if you want to further examine this one, there's a link below. Now let's look at their products. First off, their Branded Consumer Foods Group or BCF, spanning 4 categories from noodles, powdered beverages, ready-to-drink beverages, and snack foods. This I think a lot of us are familiar with, the brand and products shown in here. Next is their Agro-Industrial and Commodities or AIC. This segment is vertically integrated business comprising the Agro-Industrial Group, Sugar, Renewables, and Flour Division. AIC is designed to complement the branded consumer foods business. Now they have different facilities here in our country, which comprises of 40 branded consumer food facilities, 15 agro-industrial facilities, 13 commodity foods facilities, and 5 international sales office and distribution presence facilities. And they also have warehouses, manufacturing, and international sales offices in other countries. Now, since they have facilities in other countries, they also export their products to different countries as well. These are all the locations they export their products to, over 50 countries worldwide. Now, JG Summit Holding has a majority of shares of URC, and 44.08% is owned by the public. With that, let's go to their financials. We would still be following our checklist in evaluating this company. Again, to further understand each line of my checklist, I suggest you watch as well my other stock analysis videos. First, let's go to their income statement. By the way, I really want you to focus on this one, as this will be important later in our valuation if this stock is undervalued or not. Let's look at the revenue first. We can see the revenue has been growing yearly, but if you notice, 2016 onwards, the revenue growth drastically slowed down. And of course, in 2020, negative revenue growth. If we go to their net income, in 2017 and 2018, they had negative growth. But here's the thing, if you look at 2012 and 2020, there's not much growth. We can see their net income is even higher in 2014 up to 2016 compared to their 2018 onwards. So this isn't a good sign for me. Their earnings had been stagnant for quite a while now, not much growth in it. Now, if we look at their net income margin, we can see why their previous years are better. Their margin is way higher compared to the present years. Although the revenue increased a lot, since they have a lower net income margin, their net income also went down with it. Although it's still in their industry average, Hyundai Nissan's margin is also in the same range, 8 to 12% net income margin. By the way, in my previous analysis, I used annual average only. Now I changed it. I will be using compounded annual average. I changed it because this is much better to use when looking at the growth of companies. I will be using compounded average for revenue, net income, equity, and FCF growth rate, but for the rest, it's still the ordinary annual average. Anyway, their net income compounded growth rate is only 3.23% ever since 2010. Really low. With this, it's an X for me. Moving on to their balance sheet. Now, their equity growth is much better, growing at around 8.86% compounded average yearly since 2010. Although it slowed down quite a bit, especially this pandemic, it's still in the positive line. Not bad for the pandemic. With this, it's a check in my list. Now for their ROE, what we look at here is their 5-year ROE average. With this, they have a 5-year ROE of 14.1%. Anyway, this is a check for me. I will explain later why this is a check. Now for Monday Nissan, since we only have 3 years worth of data for us since they are new, we can only get their 3-year ROE average, which is 20.5%, so quite high. Still, this is only 3 years worth of data, and we will see later why it's higher. Moving on, let's check if their ROE is not relying on too much debt. This is the debt to equity ratio. We get this by dividing their liabilities to their equity. With this, we get 0.80, really low. What we want here is for this to be less than 2, a check for us. With this, we can see their ROE growth isn't relying on too much debt. Comparing it to Monday Nissan, they have a debt to equity of 2.18, so higher. With this, we can see the correlation of ROE to their liabilities because you can increase your ROE growth with higher liabilities. That's why it's really important to check what influenced the growth of that ROE. Is it because of their net income increased or their equity decreased because of a lot of debt? Although Monday Nissan's debt to equity isn't that high, it's still near what we want. I just want to explain the correlation of higher liabilities in the ROE. This is the reason why I checked their ROE a while ago. Next, their cash flow statements. Now, URC never had a negative free cash on hand ever since 2010. Although it fluctuated a bit in 2017, now this is because in 2016 and 2015, their FCF went up really high. Could have been great if they continued that growth, but it went back to their normal range in 2017, leaving that negative 75% growth. Anyway, although it's in the positive, this is an X for me. What I want to see is for their FCF to be growing at a much higher rate. Although we can see their free cash flow growth rate is in line with their net income growth rate. So take note on this one. Although it's an X, it's still growing, just in a slow phase. Now let's see if they can pay up their long-term debt using their free cash on hand in just under 3 years. With this, we divide their long-term debt with their FCF. We get 1.73. This means they can pay up their long-term debt using their free cash on hand in under 1.73 years. This is a check for me. For Monday Nissan, it's 3.53. Not bad, almost there. Next up, we look if they are handling their short-term obligations well. This is the current ratio. With this, we get 1.22. So another check for us. This means they have 1.22 peso of current assets for every 1 peso of current liabilities. As for Monday, they have a current ratio of 0.98. Next, we go to their PE ratio. Now, here's the thing with URC. Ever since then, they had a high PE ratio. Their current PE ratio is 23.40. This means you are paying 23.40 peso to earn 1 peso. So here's the thing. Is it worth to buy this company at this high of a PE? Looking back at their growth, we can see their earnings growth is really slow. That means in order for their earnings to catch up to its price, it would really take a long time since it's growing at a very slow pace. Anyway, let's see later for their intrinsic value what I will get. This is an X for me. Next up is the company paying out dividends. Now, since 2017, they never miss out on paying out dividends. Their dividend yield as of 2020 for the current price is 2.22%. Not bad. So for a dividend investor, if you are okay with 2% above, this is also a check for you. Next up, does the company have a moat? Now, URC for me also have a strong brand moat. Imagine, ever since I was young, all I see are their chips in the classroom, in fieldtrips, and in campings. It is a really well-known brand to every Filipino. Now, although it's lacking in financial growth because it's really growing slowly, anyway, they have a really well-handled long-term and short-term debt. That's also one thing to take note on. Although again, their earnings growth is really slow. Anyway, for a competitive advantage, I think this one is a check for me. Now for their leader, their chairman and director is Lance Gokongwei. Now in their website, there are 2 chairman and director. So if you aren't familiar with the meaning of chairman emeritus, it is an honorary position usually given to people who have retired from the position. Going back, Mr. Lance Gokongwei is also the leader of JG Summit Holdings, a large conglomerate here in our country. And for me, since their family is the founder of this company, I don't think they would let this company fall down, won't it? It's been standing for quite a long time and has grown to this degree. Now for their CEO, Erwin Lee is still new for the position, and he is the first in that position that is not a family member of the Gokongweis. He has 30 years of experience in the consumer goods industry, so let's see his performance in the upcoming years. Lastly, is it within my buy below price? My computed intrinsic value is 156.52. With a 30% margin of safety, I have a buy below price of 109.56. Quite low compared to its price. Now this is low because, as we've seen a while ago, their earnings growth is also low. That's why I ask, is it worth it to buy at this high of a PE ratio while their earnings growth is so slow? And we can see their PE ratio ever since then was hovering near 30 and even going above it. and it had stayed like that ever since. So with the PE ratio alone, we can see it is already overvalued. Anyway, this is my own valuation. Don't just rely on my computation. This is my own thoughts about the company, my own growth projections. So still do your own research and computation. With that, URC scored 8 out of 12 in my checklist, failing in my price valuations and their net income and FCF growth rate. So for me, although this is a great company, my thoughts, the price is too high for me. So just to be clear, I may be wrong here. There's no such thing as a sure valuation. The company may go up in value again, who knows? But for me, with their slow growth rate and their earnings and its price right now, it is a no for me. Although this may change in the future, their earnings may improve in time. Let's see. Anyway, I hope you liked the video. If you have any comments or information that I missed out, please do comment it down below for all of us to see. Again, if you haven't yet liked the video, do so right now, would really mean a lot to me. And if you still aren't subscribed yet, this is the time for that. So see you in the next video.